What is improvement value in commercial real estate? A property's assessed value is calculated for tax purposes and comprised of improvement value and land value. When speaking of improvement value in commercial real estate, improvements include all accessible buildings and structures on that land, not necessarily that recent improvements have been made. Understanding improvement value in commercial real estate. Your commercial real estate property is divided into the land/lot and your improvements. Improvement value in commercial real estate is the value on top of the land. An assessor places a certain value on a property to determine a tax assessment for the improvement portion of the property. This includes structures, streets, and even sewer connections on that piece of land. Because land does not depreciate, the improvement value will be the depreciable amount. Improvement value varies by county, and the assessment value typically has no relation to its market value. Land value versus improvement value. Since land cannot depreciate, you must allocate the original purchase price between the land and the structures or improvements on top of it. Using the values from the property tax assessor, you can calculate the ratio of the value of the land to the value of the improvements. To calculate the ratio, you must take the original purchase price of the property and split it into two subcategories: land value and improvement value. The improvement value is the difference between the total purchase price of the commercial real estate property and the land value, plus the cost of buildings and other improvements added. Calculating improvement value in commercial real estate. The higher the improvement ratio, the higher the amount of value allocated to the property, and the lower the amount allocated to the land. This results in a higher annual depreciation amount. Here's an example. You purchase a piece of commercial real estate for $1 million with a 90% improvement ratio. That means $900,000 of value is allocated to the building and improvements, which is depreciable over the asset's useful life, and $100,000 is allocated to the land. Keep in mind that the improvement ratio will never be 100% as land always has value. There are 3 ways to determine your improvement ratio. Property tax card. A representation of what the assessor thinks your property is worth. Buyer-seller appraisals. Having an appraisal on your property can help you calculate your improvement ratio. Replacement cost and land sale comps. Appraisal reports and insurance estimates typically provide replacement cost values. Replacement cost is the cost to construct a new asset according to its current worth. Land sale comps can also be accessed to determine the value of the land. They can be found from a variety of sources, including third-party websites, county offices, or agents with access to the MLS. Knowing your improvement value on your commercial real estate property will be useful when tax season arrives. Calculating your improvement ratio to increase your annual depreciation expense will be one of the most helpful calculations you will make. Let Realized build you a passive, diversified portfolio designed with minimal uncertainty while avoiding as much capital, income, and estate taxes as possible. To learn more or book a consultation, check the links in this video's description. Thank you for watching.